Hello and welcome back. I'm happy you made it this far and thank you for taking the time to participate in our Credit as an Asset series. In this lesson, we're going to learn the life cycle of a charge-off account, consumer rights, and how you can protect your credit during the COVID-19 epidemic. Let's begin with the life cycle of a charge-off account. Before we begin, let's go over what are charge-off and collections. A charge-off account is a debt. For example, a credit card that has been substantially delinquent and after a period of time, the lender gives up on pursuing the debt and either transfer it to the internal collection or sells it to a third-party collection agency. A collection are delinquent or past due accounts that are transferred out of the routine account processing to an internal collection department or third-party debt collection agency. If the debt is transferred to a third-party collection agency, it's possible that both the collection and the original account appears on your credit report. Let's discuss date of first delinquency. I know we briefly talked about this in our last session, but I wanted to go a little deeper on this topic because if you're in the process of repairing your credit or reestablishing your credit, then you're going to need this information as part of your strategy. The date of first delinquency is when an account goes 30 days past due or more, leading to the current derogatory status. And this date determines when an account falls off your credit report. The date of first delinquency does not change unless you make a payment and the account is brought up to date and is still open. Let's look at an example. Here we have Xavier. He took out a loan on March 15 of 2012. There's no date of first delinquency recorded because this is a new account. He was on time until a year later. On April 15, 2013, he missed his first payment. There's no date of first delinquency because it hasn't been reported to the credit bureau and he's not 30 days late yet. If you're 1 week late, 2 and 3 weeks late, yes, that's not good and you could potentially pay some late fees and also ruin your relationship with the lender, but it's not reported to the credit bureau until it's 30 days past due. A month later, on May 15 of 2013, his account now is 30 days past due. The date of his first delinquency is not recorded. What this means is that his account will fall off his credit report 7 years and 180 days from this date. The following month, on June 15 of 2013, his account now is 60 days past due. The date of first delinquency has not changed. Next month, July 15, 2013, Xavier paid this past due balance and brought his account current. Because his account is still active and open, the date of first delinquency is now erased. The next month, on August 15, 2013, he misses a payment. There's no date of first delinquency. The account has not reached 30 days past due yet, and the missed payment has not been reported on his credit report. The following month, on September 15 of 2013, the account now is 30 days past due. The date of first delinquency is now recorded as September 15 of 2013. Xavier didn't make a payment for the next 3 months. So on December 15 of 2013, his account is now 120 days past due and the lender has charged it off. Now that the account is charged off, this is the point of no return. The account is closed, it cannot be reopened, and the date of first delinquency will never change, even if he makes a payment. This account is scheduled to be deleted from his credit history 7 years and 180 days from the date of first delinquency. The following year, on March 28, 2013, Xavier paid off the charge-off amount in full. The date of first delinquency do not change. It is still scheduled to be removed from his credit history 7 years from September 15 of 2013. So in summary, the date of first delinquency determines when an account falls off your credit report, when an account goes 30 days past due, leading up to the current derogatory status. If you have more questions on this, please connect with me at the community board at mysavingsjar.org. So what happens next? If he pays the original creditor, the account is going to be reported as account paid in full was the charge-off, and it remains on his credit report for 7 years and 180 days. If he makes no payments, the original creditor could transfer the account to either an internal or external collection agency. If it is transferred, the original account and the new collection account can both appear on his credit report and remain on his report for 7 years and 180 days from the date of first delinquency. This information is important to know because when you're doing an audit of your credit report, you want to know what accounts, what debt to prioritize. And you want to know when collections and charge of accounts are going to get removed from your credit history. Now let's move on to another important topic, understanding consumer rights relating to credit and consumer protection. While there are many consumer protection laws, I want to discuss a few that directly impact consumer credit. Let's take a look at each one of these. The Truth in Lending Act, TILA for short, TILA, is a federal law enacted in 1968 to help protect consumers in their dealings with lenders and creditors. Under the Truth in Lending Act, lenders are required to disclose the true cost of your loan, such as loan amount, APR, finance charges, payment schedule, total repayment amount. If you ever finance the car, you will notice that in your contract or your agreement to pay, on the very first page, there's a breakdown of how much the loan is truly going to cost you, with all fees and your interest and down payment. Next, we have the Car Act of 2009, which is a federal law designed to protect credit card users from abusive lending practices by car issuers. The Card Act was signed into law in May of 2009 by then President Barack Obama. It limits certain fees and interest rate charges. For example, it does not permit credit card companies to let an account go over its limit and then charge you a fee for doing so. You have to be given the choice to opt in to over limit charges on your credit account. If you decline to opt in, you will have your card decline if you don't have enough available credit for your purchase. It also limits excessive marketing and access to credit cards for youth. It prohibits issuers from using inducements such as free pizza, free speed, or t-shirts to market credit cards on or near college campus. I remember when I first started college, that's how I got my first credit card. They used to have a table outside, and they'll be giving out free t-shirts or something for free. And it was just like, all you need to do is fill out this application and sign here. It also added an age restriction. Consumers can apply for credit cards starting at age 18, but the law prohibits issuing cards to those under 21 unless that they have independent income or a cosigner. The law also requires that issuers inform you how long it will take for you to pay off an existing balance if you just pay the minimum each month. So if you have a credit card, on your statement, this information should be on the first page. Next, we have the Equal Credit Opportunity Act, and this was enacted in 1974. It prohibits credit discrimination on the basis of race, color, religion, national origin, sex, marital status, age, or because you get public assistance. Organizations that show a pattern of discrimination can have lawsuits brought against them by the Department of Justice. Joined by other government agencies, the Consumer Financial Protection Bureau supervises the compliance and is in charge of enforcing this law. If you apply for credit and get denied, the creditor are required, per the Equal Credit Opportunity Act and the Fair Credit Reporting Act, to notify you of the reason why you got denied, and in some cases, provide you with credit score information and the ability to access a free credit report. If you ever deny credit, you probably receive one of these letters in the mail. The Fair Credit Reporting Act, FCRA for short, is a federal law that helps to ensure the accuracy, fairness, and privacy of the information in your credit report. The law regulates the way credit reporting agencies can collect, assess, use, and share the data they collect in your consumer report. So this means your nosy neighbor cannot access your credit report. To get a copy of your free yearly report, you can go to annualcreditreport.com. Because of the COVID-19 crisis, the bureaus are allowing free weekly reports until April of 2021. So how does the Fair Credit Reporting app help you? It gives you the right to be told if information in your credit file is used against you to deny your application for credit. Also, it gives you the right to request and access all the information a consumer reporting agency has about you. This is called the Consumer Disclosure Report, which we learned in Lesson 2, Understanding Credit. If you find what you believe to be inaccurate or incomplete information on your credit report, you have a right to dispute it. The credit bureau would then contact the data furnisher to confirm whether the information is correct. If it is not, the credit bureau will either correct it or remove it within a time period. This is useful because you have a right to dispute collections and they are required to validate the debt in question. And if they cannot validate the debt, then they have to remove it from your credit report. This is what many credit repair companies do, and I'm here to show you how you can do this yourself. If you want to learn more and you have a specific question about this, go on over to the community board and connect with me at mysavingsjar.org. Now let's switch gears and consider how to protect credit from the consumer's perspective. During this time, some of us are more focused on credit protection than on the act of credit building. This element of credit is highly important, especially during this crisis. When the COVID-19 crisis impacts your ability to pay your bills, it's important to take immediate action to mitigate the potential harm to your credit profile, as even one late payment on your credit account could equate to up to a 100-point drop, and we don't want to miss the limited window to avoid this situation when possible. A good start is to do an assessment of your income, expenses, and saving to consider realistic ability to repay. When there's the ability to trim expenses by cutting non-essential, this of course is an excellent first step. But of course, these are not often the primary make it or break it expenses. Once an inventory has been outlined and the extras that can be cut out are trimmed, consider taking the following steps. Contact your creditor as soon as possible to inform them that you have been affected. Discuss all options and confirm those in writing. Second, pull and retain a copy of your credit report from one of the 3 credit bureaus. Requesting a credit reporting during or immediately after disaster or crisis can help to reflect your financial situation before any financial impact. As a result, you can later make the case to a lender or someone else checking your credit report, such as a potential future landlord, that the disaster, not the financial mismanagement, caused the credit score to drop. Lastly, consider adding a 100-word consumer statement to the credit report. You could note that the financial hardship occurred as a result of COVID and how it has caused your score to suffer. While this has no effect on the credit score, it does convey this to any future creditors reviewing your credit report and could affect the decision to lend. Be sure to update when appropriate. Let's dig a little deeper into each of one of these steps. As this pandemic continues, we are already seeing and will continue to see new waves of consumers affected. The plans available to the first wave of unemployed may not be the same as what's available to future waves. Given the uncertainty, it's an opportune time for all of us to review our expenses and take action to trim as needed. When we look at our accounts, we want to prioritize those which are reported to the credit bureaus. But we shouldn't ignore those that are not reported, like rent, utilities, cell phone bills, insurance, as we know that these can easily pop up later. As the country faces mass unemployment, we know that the creditors' phones are also ringing off the hook. It's a challenge in and of itself to simply get a hold of a creditor. So as much as possible, upon initial contact, try to consider alternative forms of communication beyond the phone, like social media and online chat. These may offer a faster line of communication. For those cards with annual fees or rewards that cannot be tapped into during this time, there may be offers to waive fees, recession offers to keep customers, new perks and ability to drop to a lower tier of a card that may retain the relationship but minimize the expense. The decision to grant commendation for credit cards and car loans, for example, that's going to depend on the discretion of the lender. So I highly encourage you to call your credit card company and see if they have any special programs for people affected by COVID-19. Regarding student loans, when the CARES Act passed back in March 27th, an automatic deferment with 0% interest on federal loan, specifically for those with direct loan, Perkins loan, or federal family educational loan owned by the U.S. Department of Education, went into effect. These means that these loans enter into an automatic payment suspension backdated to March 13. For mortgages, similar to federal student loans, the CARES Act also required forbearance for certain federal mortgages owned by Fannie and Freddie, as well as the USDA and the FHA and the VA. The Act leaves ambiguity in the interpretation of the language, and each agency may have different guidance as it relates to the length of time for forbearance. Our understanding is that the most standard immediate forbearance is for a period of 90 days, but importantly, the borrower can request a longer forbearance should they be directly or indirectly affected by COVID-19. For borrowers that are not covered by the government, there may be accommodations available, but it's not guaranteed. As with all advice, contact the creditor directly for guidance. And lastly, consider canceling overdraft for payments that cannot be made. While we never want to promote non-payment, we know that the reality of the crisis is the balancing act of who to pay, often a robbing Peter to pay Paul sort of moment. At the very least, this at least prevents the piling up of insufficient fees. If you're affected by COVID-19, there are different ways that creditors may work with you. One thing is for certain, unless we inquire, most creditors are not going to automatically apply a payment relief. So some options that you should consider looking into: maintain long term but with flexibility. Maybe ask for an extended due date or grace period. Ask to waive fees. Or are there any special reporting codes that indicate that an account has been impacted by the crisis? We don't know unless that we call, we nag. So I highly encourage you to contact your lender to see if these options are available to you. In addition, you can ask for a forbearance or deferment of your loans if you're affected by COVID-19. It would be good to inquire, can payments be postponed for a period of time? Can interest-only payments be made? Or can payments be shifted to the end of the term, for example, for a balloon or extended term? And lastly, loan modification. If payment relief is unlikely, a last resort to consider may include loan modification. Can or do new documents need to be signed? Can delinquent or bad debt be refinanced or restructured? With the recently passed CARES Act, or Coronavirus Aid, Relief, and Economic Security Act, there are a few considerations around credit payments and reporting that are important to understand. How your credit reports your account depends on the status of the account, when the agreement or accommodation was made. If your account is current and you make an agreement to make partial payment or skip a payment or other accommodation, then the creditor is to report to the credit reporting agency that you are current on your loan or account. This only applies if you are meeting the terms of their agreement. If your account is already delinquent and you make an agreement to pay, then the account will maintain that status through their agreement until you bring the account current. If your account is already delinquent and you make an agreement and you bring your account current, then the creditor must report that you are current on your loan. These terms only apply to agreements made between January 31st and the latter of either 120 days after March 27th or 120 days after the national emergency concerning COVID-19 ends. This act also applies to certain federal student loans and includes requirements related to suspending payments and credit reporting. These accounts will retain the same reporting status as if they were regular scheduled payments made by the borrower. This policy, however, does not apply to any charge-off debt. So what impact do credit accommodations such as forbearance, deferment, loan modification have on your credit score? Well, as with everything else, it depends. There are many considerations affecting the score impact, including what else is on your credit report. For example, are there past due accounts that cannot be placed into special accommodation, or a collection that recently popped up that's weighing down your score? What was the status of the account in question prior to COVID-19? As we saw on the previous slide, the original status pre-COVID affects how the account may be reported. An account that is current versus delinquent versus caught up post-COVID will have a distinct accommodations available. How is the creditor reporting the account? Lenders have the ability to select how they will report this account. Oftentimes, there's no way of knowing what this looks like unless that you actively reach out to the creditor and ask. Also, what credit score is being considered? First, which score? Remember that there are many different credit scores designed for different lending purposes. Second, the score modelers also specifically account for these differences in different ways. Next, pull and keep a copy of your credit report. This is good when applying for credit in the future. For example, if you are applying for an apartment and you're applying with a future landlord, you could at least show what your credit report was looking like prior to COVID-19 and can demonstrate that your credit report at the time, if it's bad or you have negative items or missed payments, that it wasn't because of your mismanagement of your finances. It was due to the crisis. As stated earlier, you are entitled to a free weekly credit report from annualcreditreport.com. Now through April 2021, you could get 6 free credit reports every 12 months from Equifax. And if you get denied credit, you're also entitled to a free credit report. So there's many ways to get your credit report. An option that always exists to consumer, but maybe one to consider during this pandemic, is to add a 100-word consumer statement. The process is going to be slightly different by bureau. In some cases, it will be an account-specific data that can be included within the consumer statement. In others, it's a reported-wide ad with a personal statement addressing the financial hardship. In order for you to add a comment, you can visit each credit bureau individually or access via annualcreditreport.com and add as you download each credit bureau. While there's no telling how creditors may view this, it may offer you some additional layer of relief knowing that you took in the action within your control. When it comes to statements related to delinquency due to natural or declared disaster, it can remain on your credit report for up to 2 years. However, you can also request a removal if your situation has since changed. Report. Thank you for joining me today, and I hope to see you in our next class. We're going to discuss debt, but in the context of credit building, and look at different credit building products and start moving from theory to action. See you soon.